Good morning and welcome to this Wednesday, July 14th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we got another pretty crazy inflation reading this morning. Of course, yesterday we had the June CPI, the Consumer Price Index, and the core CPI both come in well above expectations, rising 0.9% versus the expected 0.5%. And now this morning we have the June PPI and core PPI coming out. Of course, PPI is the producer price index, so at the producer level. And that too showed a very, very hot reading for June, rising 1%. The PPI up 1% versus 0.6% expected. Core PPI also up 1% versus 0.5%. So we're getting the hot readings, but the reaction I'm seeing in the market is ignoring inflation. And that is more important than the actual readings themselves, because the readings create a lot of headlines and so forth. But how does Wall Street feel about it? To me, that's much more important, because they're the ones going to be doing a lot of the investing of the money. And so following the charts, following where the money's going, where it's not going, gives us a pretty good idea of whether or not Wall Street believes that we really and truly have an inflation problem going forward. And I would say, based on this reaction right now, we don't have a problem. This morning, I was shocked when I saw the report come out on the June PPI. I mean, I'm not surprised of the numbers. I mean, we've talked about this over the last few months. We anticipated higher inflation reports coming out monthly. We're in this pandemic. We're coming out, the economy's picking up. Prices everywhere have been going up because all of a sudden, in the past several months, we've had a supply chain disruption, and now all of a sudden you got all this demand and supply's trying to catch up. Well, if you don't have enough supply and you got a lot of demand, it's economics 101. Prices are going to go higher. But once you catch up on the supply side and the demand begins to wane a little bit, we're going to balance back out again. And that's what the Fed has been saying. And that's really the way the market's been reacting. I'll go over the 10-year Treasury yield with you in a minute. But I looked at it just a couple of minutes ago, and it's down. The yield is down 5 basis points this morning. Pretty much everything we gained yesterday is gone today. So with these two huge inflation reports, CPI and PPI, well above expectations for June, the bond market is yawning. If inflation was a problem, the bond market would not be yawning. Okay, so let's go ahead first. I'm going to take you over to Earnings Beats. For those of you who are new to Earnings Beats, we do have a free newsletter. I would highly encourage you to check this out. There's no credit card required. You can unsubscribe at any time. We do it more from an educational perspective, not just to educate about the market, but also to educate about how we look at the market at Earnings Beats. All you need to do is type in your name, email address, hit that subscribe button. We'll make sure you get set up. But it's the EB Digest is one that I publish 3 times a week, Mondays, Wednesdays, and Fridays. So 3 times a week, usually out well before the market opens. We try to get it out an hour or so before the market, maybe even a little bit more. But it'll give you time to digest something about the market, something that's taking place within the market. Maybe it's something about candlesticks. It could be relative strength, earnings. But we do try to keep it on topic with many of the things that we look for at Earnings Beats. And so again, just type in your name, email address from our homepage. It's very easy to sign up for. We'd love to have you. All right, let's take a look at what happened on Tuesday before we get into what we might see on Wednesday. And you can take a look and see that the market reversed on Tuesday. The Dow Jones down 107 points, the S&P down 15, NASDAQ down 55. All of those, down roughly 1/3%. So we're not talking big numbers. But on the heels of the inflation report, I'm sure there were a lot of folks spooked. I can tell you from my perspective, the hardest thing is not really which way I think the stock market's going. I've been saying this for months. It's the rotation. It's the rotation that's driving me crazy. Trying to figure out, okay, are the the low interest rate environment stocks, the growth stocks going to lead? Is it the reopening stocks? You know, as the economy strengthens, we would expect yields to go up. So is it going to be more of these value-oriented stocks that are going to lead? Well, the stock market's been casting its vote lately, and it's pointing us toward the growth, but not just any growth. It's been the large cap growth. And we'll talk a little bit more about that in just a minute as well. But anyway, the mid caps down 41, small caps down 26. And you can take one look at the chart. You can see the Dow breaking to new all-time highs, the S&P breaking to new all-time highs, NASDAQ breaking to new all-time highs. And then look at mid caps and small caps. They've been hurt because there are a lot of small cap stocks that are in areas that have been struggling of late, notably energy, materials, those types of areas of the market, which have not been keeping pace with the S&P 500. And as a result, the mid caps and small caps have been moving lower. An interesting fact, though, here is that look at the AED line on the mid cap index, putting in new highs, even though we haven't seen a price high in a few months. So I think that's a real positive development. Small caps been trending lower in the short term, last 4 weeks or so. But overall, when you look further out, we have been rising. I suspect everything's going to continue to go higher. My only question in the near term, knowing that history is on the side of the bears as we get past July 17th, and this current pre-earnings run that we're on right now, that tends to end right at about, you know, when we start with all these bank reports coming out. And that's what we're seeing now. Yesterday we had JP Morgan. Today we got Wells Fargo. We've got Bank of America, Citigroup, PNC, BlackRock. They're not a bank, they're investment services. But we got all of these financial firms that are starting to report. And this is when you got to start being a little bit more careful. I'm not saying the market's not going to go higher. I think it could be a little choppier now that we've made this run. I mean, that's quite a run we've seen in the NASDAQ, the S&P, and the Dow. And this is typical of what we tend to see. And I'll show you a chart in just a minute, kind of verifies that. 10-year Treasury yield. So today, like I mentioned, the PPI came out much hotter than expected. Normally, hot inflation, hotter than expected inflation, you'd see everybody wanting to bail on bonds. They would be selling. Treasury prices would be going down, yields would be soaring. We're in a downtrend on the Treasury yield. This doesn't make a lot of sense if you truly believe inflation's a problem. If you believe inflation's a problem right now, the stock market and the bond market are disagreeing with you. There's nothing that would keep rates down if we have an inflation problem, because the Fed is going to be backed into a corner. The Fed will have to start raising rates to battle inflation. And if you know that rates are going to go up with the Fed, you want to be out of bonds because your bonds begin losing value. So you should see, folks, on a mass exodus, we should see the yield back up to 160. I mean, like up 10 basis points, 15 basis points. That would be something that you'd say, hey, based on these reports, the bond market's nervous about inflation. We're not seeing that. So that's the story I'm getting from this chart. And as I always say, these charts tell us a story. I'd much rather hear this story on the charts than to hear the story, whatever they're telling over at CNBC. To me, the charts don't lie. This is where the money's going. This isn't the lips moving. This is the money moving. So anyhow, 10-year Treasury yield to me looks pretty tame. This reaction this morning to a hot inflation report is very surprising. I mean, I don't know how else to say it. I'm very surprised that we didn't see yields higher today. But right now, not the case. Now, yesterday we saw yields all over the place. Didn't get much of a reaction on the inflation report yesterday morning on the CPI either. If we just do a 10-minute, 5-day chart, look at yesterday. So here was the initial move lower. Then we came out with the inflation data. We went up temporarily a few basis points, and then we came right back down. So just after the stock market had opened, rates were down, even though we had a hot inflation report. And then later in the afternoon, we finally saw the yields move up. And as a result, in the last 2 hours, we saw a lot of the growth stocks getting hit back to the downside. And now today, after another hot inflation report, we're starting off to the downside again. Is this a another wild day where we're going to be down and then we're going to come roaring back in yields later and hurt growth stocks? I don't know, but right now the NASDAQ's leading in terms of futures. So it's going to be a very interesting day to say the least. And this battle, and from what I'm seeing, it's not really a battle. I don't think the market is worried about inflation. Big picture. Short term, though, news articles come out and so forth. It could be a story that's used to drive the stock market down from these all-time highs. It's going to be a very interesting next couple of weeks as earnings come out. Historical bearishness sets in. We've got the inflation reports. Where are things going to go? I think we're going to see a lot more choppiness like we've been seeing. I think it's going to make for a difficult trading environment. All right, and we can already see banks, which, by the way, I've looked at earnings now for the last 2 days, yesterday morning, and the big companies, when they first report, the first week or so of earnings season, you see almost every company reporting their earnings before the market opens. Once we start getting into more tech stocks, consumer discretionary names, many more companies will report in the afternoons after the market closes. So right now, it's pretty much all about the mornings. But yesterday morning and this morning, of all the companies I saw, not one missed earnings expectations, not one. And I'm saying any company that has a market cap over, say, $1 billion, and there've probably been close to maybe a dozen so far, they're not just beating, they are shellacking estimates. That's why, for me, forget about PE ratios. Everybody always wants to talk about how the market's overpriced based on PE. Well, the problem is, and they think that the price part of that equation is the only thing that can change, so that therefore prices have to come down so the PE ratio will drop. Well, another way that the ratio will drop is when earnings go higher than expected, because this isn't factored into the PE ratios. Listen to these earnings this morning. Bank of America expected to earn 77 cents. They earned $1.03. $1.03. That's a 33% beat. 33%. That's not beating by a penny or two. Wells Fargo expected to come up with earnings of 95 cents. They posted $1.38. That's getting close to 50% beat. Citigroup, $1.94 was the expectation. How about $2.84? Once again, another 50% beat in earnings. BlackRock was one of the disappointments today. It was expected to earn $9.33. It only earned $10.03. So what's that, about an 8% beat? PNC expected to earn $3.16. They earned $4.50. Now, part of what's going on with the banks right now is last year with the pandemic, many of these banks increased their loan loss reserves by a ton. I mean, it was a pandemic. Nobody knew. Everybody thought, we were headed for the Great Depression. So, of course, many of these loans were going to go bad. Well, through some of the efforts of the government, through some of the, through a lot of the rebound in the economy, and the fact that this turned out to be much more of a healthcare crisis than it did a financial crisis, many of these loan loss reserves that were built up weren't necessary. And so we're getting this one-time charge. We had the one-time charge. We're now getting a one-time benefit of lowering those reserves, which in turn increases earnings for these banks. So that's part of what's going on here. Delta Airlines expected to lose $1.41. According to Zacks, lost $1.07. Now, I saw a headline where they turned a profit. I don't know I didn't read the article, but what I'm seeing on Zacks was still a loss of $1.07, but that's much better than the loss of $1.41 that was expected. The only one in the last 2 days that actually matched expectations was INFY. So if we pull this chart up, INFY, and I'll get into some more earnings in a little bit, but INFY, and I'm going to pull up the relative strength chart. I mean, this is a company that had been looking pretty strong on a relative basis. So I was a little surprised that they just matched estimates. But believe it or not, all these companies I just pointed out, these 7 companies I just talked about earnings, the one that matched is the one that is having the best pre-market reaction this morning. INFY is up 3.3%. Three of the financials I pointed out, Bank of America, BlackRock, and PNC Financial, are down after those crazy good earnings reports. They're down, but many of the banks have been running to the upside. So it's a buy on rumor, sell on news. In the case of INFY, I'm not sure what it is, except the AD line's broken out to a new high. It's been a great relative performer. It's been going sideways here for the last few weeks, but they just matched expectations, stock up 3% after or in pre-market. So it looks like probably get a breakout on this one. All right, what I want to talk about in talking technically today, let's move on. The S&P 500. Now, I've said on many occasions, I wrote about it in Chart Watchers not that long ago, probably a few weeks ago before this, maybe just as the time this was getting started, this pre-earnings run. But I've said how the S&P 500 has an annualized return. If we look at just the few weeks heading up to the kickoff of earnings season, so the end of the third calendar month of each quarter into the beginning of the first month of the next calendar quarter. So June into July, March into April, December into January, and September into October. Those are the 4 pre-earnings periods. And I wrote an article. You can go into Chart Watchers. Actually, I'll show you. Let me see if I can find it real quick for you. If you go into the articles and then just go to Chart Watchers, probably have to go back a few pages because it's probably been 3-4 weeks since I wrote it. But it was basically Wall Street doesn't want you to see these numbers, kind of a headline. Let me see if I can find this for you real quick. Here it is, May 21st. So when did this start? June 18th. So I wrote this a month before this actual pre-earnings run began. But I want you to look at these numbers. So here's the table that I provided showing the 4 pre-earnings run-ups, basically the 3 weeks that I talked about, with one exception. December, I actually went back a little bit further because you got the Santa Claus rally and then the pre-earnings run-up. But if you look at these, I've calculated the number of days that we've seen up days in these periods, how many down days we've seen in this period. So it's not like you go up every day. You can see that, roughly maybe if you combined all 4 of these, maybe it's 56%, 57% would be the percentage up days. Throughout the entire year, it's 53.5%. So there's definitely more of a tendency for the market to go up during these days. But then when you calculate the annualized return for each of these periods, if we take the total of all these 4 pre-earnings periods, you'll see that the annualized return is 24.54%. And if I take all the other days of the year, the annualized return is 4%. There's no doubt that the stock market anticipates Wall Street buys before the numbers come out. All these numbers you're seeing right now, Bank of America blowing numbers away, BlackRock, PNC, they're down this morning in pre-market after reporting great numbers, but they've been going up in this pre-earnings period. Wall Street bids them up, and then Wall Street stops buying when the earnings come out. Buy on rumor, sell on news. So the rest of us, most people who don't understand how the market works, looks at this great report, Bank of America, and says, wow, it's down a little bit. I'm buying today. And then the next thing you know, 5, 6, 7 days later, you're still in that sell on the news move, and people are scratching their heads. They think stock market is fixed. Well, it kind of is, but it also isn't. You just have to understand how it works. Pre-earnings, the stock market goes higher. Not every pre-earnings, but there's obviously a major tendency. So now let's look at these blue arrows, and you can kind of see the dates don't exactly line up with the dates I just gave in those tables, but they're pretty close. I mean, you can see we're going from the prior calendar month into the current calendar month where the earnings are reported, and you can see these uptrends. Last 4 for 4. After the April, look at what happened April and May and into June. Next 2 months, we were pretty flat. Look what happened here. Next 2 months, we were pretty flat. Here, we actually went down, then we came back up. We finished up a little bit. But the big moves are occurring prior to earnings season. But then earnings come out, everybody wants to jump on board, and the market makers are just taking your money because the market doesn't go anywhere. You get frustrated. So we've got that to look forward to. Sorry to ruin your morning. But that's just typical market action. It's not that I think that we're in trouble going forward, but don't be shocked if we're choppy. And July 17th at the close until September 26th at the close, that is the worst time of the year historically. Forget about go away in May. That I get so irritated. My blood pressure rises when I see articles because that's just, it rhymes, but it's not true. You know, you don't want to go away in May. I mean, here, yeah, we went sideways. We went down for a little bit, went sideways for a while. But if you go away in May, that whole theory is based on going away in May and not coming back until November. You're going to lose money if you do that. Market goes higher between May 1st and October 31st. It doesn't go up as much. I mean, that part's true, but it goes up. So just go away in May without any explanation is irresponsible journalism, in my opinion. Because you look at this period. I mean, this has been a great period. You want to be away? You don't want to be in this? This is the numbers. Look at the S&P 500. Since June 18th, the June 18th close, the S&P is up 4.87%, Dow Jones 4.8, NASDAQ 4.61. Look at the makeup of the sectors. Since June 18th, this is what these sectors have done through yesterday's close. Technology leading the way, 7.13%. Consumer discretionary, 5.61%. Next, communication services, 4.55%. When you're going into earnings, generally you want to overweight those groups, especially when we're in a secular bull market. It would have worked here. Now, the XLC was actually underperforming the S&P 500. And when you look at this, if you're in individual sectors, 9 of the 11 sectors underperform the S&P 500. Why? Because the strength was in large cap growth. Apple, Microsoft, Amazon, Tesla, the ones that lead the XLK and the XLY are also big components of the S&P 500. It's market cap weighted. So these large cap stocks are driving the market right now. I mean, it's good on the one hand, but you can see it's not bringing everything up to the same extent as we're seeing technology and consumer discretionary. So some of the big names are doing really well right now and beating the S&P 500, and they're carrying the S&P 500 because the other areas are not doing nearly as well. Let me go back and show you one more time, mid caps and small caps. They're not participating. Okay, so that's what we got going on right now. So if you're in the large cap growth stocks right now, you're loving life. Apple, I mean, look at Apple's chart. It's been straight up here heading into earnings. And this is not unusual. Straight up heading into earnings there. Into October, really nice move heading into earnings. Not so much in January. We moved up at the end of December, pulled back, and then we made one last run. Apple will report somewhere around fourth week, end of the third week, beginning of the fourth week, something like that. Or maybe even end of the fourth week. It's probably like around the 26th, 27th. If you ever want to know, if you go to symbol summary and just type in your symbol, it'll tell you down here, next earnings date, 7/27. So July 27th, Apple reports. Now, historically, what I would say is probably get out before earnings. Or if you want to hold, maybe sell half before earnings. Earnings come out, sell the other half, because after earnings, the market's already built in a lot of good stuff. So I would say that probably we're not going to see, and I'm just saying probably, no guarantee, but I would say probably by the time we get to Apple's earnings, most of the gains will have been made. And you can see pre-market another almost 2%. So these large cap growths are definitely moving higher and pulling the indexes up, but this has not been a widely participated in advance. And you can really see that by looking at the, if I go back here, by looking at these sector percentage gains and the fact that 9 out of 11 have underperformed the S&P 500. The other thing I thought was pretty interesting is that with technology and consumer discretionary and these large cap growth leading, NASDAQ is not leading the S&P 500. So of all of this, I think that's probably the most surprising to me. And maybe that'll change here over the next couple of days, but at least for now, the S&P's hanging in there. All right. I thought what we would do next is I'm going to take a look at just a couple of industry groups within technology and consumer discretionary, because not every area within technology and consumer discretionary, it's not like everything is, knocking the cover off the ball. We've got some areas that are not performing particularly well. I'm going to show you those here in 1 second. Okay, so first, let's go ahead and look at the computer services. So computer services on an absolute basis is, pushing up, sideways consolidating. I think it's in a nice pattern. I would call this a little bit of a bull flag, maybe. Sideways rectangular consolidation after an uptrend. But it's just consolidating. It's not going up with the market here over the last, you can see from June 18th, which is right here. It's probably up 1%. So it's underperforming its peers. Next up, let's look at semiconductors. Semiconductors have been making pretty nice run from the 18th, but not as much as the overall technology group. So it's been lagging, but still breaking out the new highs. So this is a group that still looks very strong to me. Software has been very strong. So here back on the 18th, we were sitting at about 49.80. Now we're at almost 5,300. So that's going to be over 300 points. It's probably up about 6% in that neighborhood. But again, it's being led mostly by the large cap, like Microsoft. Look at Microsoft chart. See, Microsoft is really helping that software index. It's not your mid caps and your small cap software. Some of those might be doing okay, but by and large, it's the large cap software that's doing well. So you got Microsoft. I know Oracle's kind of bounced back. You can see the huge move there. Next up, let's look at the electronic equipment. Electronic equipment since that June 18th low, also breaking to new highs. So this group looks pretty good. Computer hardware has been strong, and that's Apple. So here's your June 18th, and there's breaking out to a new high. And you might be looking at this and saying, well, it's too late now to go into some of those stocks. And I agree, it is. I'd be a little careful because many of them are stretched. But remember this for next quarter. Remember that technology, consumer discretionary, many of these companies tend to perform really well heading into earnings. So when we get to the end of this historical period that is bearish in September 26th, that's the beginning of a pre-earnings run into October. So at that point, even if the market is looking kind of sketchy, in my opinion, that's when you want to start getting a little bit more aggressive with the market. All right, next up is the electrical components. This is one group that has not really been performing as well. We have bounced off of June 14th, but we haven't moved to new highs. I just think last few months we're underperforming. I think we got to be a little careful with this group. Then we've got the telecom equipment. It too has been rising since the 18th, but it hasn't broken out. It's been kind of a muted advance. So on a relative basis, underperforming its technology peers. Then we've got renewable energy, which is the most volatile area of the market. It's done pretty well over the last few weeks, better than the overall group, the technology group. But I'd be watching because I see perhaps a bottoming head and shoulder pattern. Left shoulder, neckline, head, right side of the neckline had that failed breakout. Pulled back, this could be a right shoulder. Break back through 260 would be very bullish for renewable energy. You might say, well, yeah, but that's $24. That's 10% from where we are. Take a look at how fast renewable energy moves. If we get a breakout, I'm not going to worry about what price it is, to be honest. I'll be definitely trading more renewable energy stocks if we get that next breakout. And an aggressive way to trade it is to get it on a pullback, anything down around the 220, 230 area, potentially near a right shoulder bottom would be the more aggressive place to enter. I think once we get through 260, we're kind of confirming the bottoming pattern. So I think it's less risky at 260. It doesn't make sense maybe to some who are not technicians, but I think above 260 is less risky than buying at 236 because we haven't broken this bottoming pattern yet, which means we could just keep drifting back to the downside. So you got to be aware of that. Just a couple, let's see, how much time do we have here? Oh, it's 9:30. Maybe tomorrow or next time we'll look at the consumer discretionary. I do want to just take a look at some of these earnings that came out. So let's start with Bank of America. We'll get exactly where we are since the market's opening. So Bank of America was down 1.78 when I looked earlier in pre-market. It is now down 1.35. I'd watch this double bottom right here. I'd be surprised if Bank of America goes below that. At least closes below that. Intraday, anything's possible, as we know. Wells Fargo, I think this is one of the better banks out there, and it is up almost 1% today. It's been sideways consolidating, which I think is fine after the huge run it made, but it's shown a lot of relative strength, as has PNC Financial. PNC down about 1% today, but on a relative basis, you might look and say, well, it's been going down. But if we pull it up on a relative basis, you can see PNC is right near a 52-week relative high versus banks. Banks have been pulling back. So, of course, if your group is pulling back, then the stock itself is likely to pull back. But it's been pulling back less than the bank index, and that's why the relative strength's been going up. Citigroup, on the other hand, has not been a good stock in this area. It is up almost 3%, so it's having a little bit more of a dead cat bounce. But look at this move to the downside. I'd be careful if Citigroup fails to break through its 20-day, because on a relative basis, it was down near a 52-week low. So you can kind of see this, instead of buying on rumors, sell on news, like we're seeing with some of the other banks that have been strong. We're actually getting a sell on rumor, buy on news with Citigroup going the other way. And the last one I wanted to show is just Delta. Let's see what Delta is doing here. Oh, and I do want to show INFY as well. So we'll do that one. But Delta up a little bit, but it's downtrending. So even with the better than expected earnings report, we're in a downtrend right now. Until we can break that 20-day EMA, I'd be careful with Delta and the airlines. INFY breaking out. So it gapped up and it's breaking out. I expect that we're probably going to continue to see higher prices, even though it matched expectations. It's not going to be on our strong earnings chart list because it didn't beat its earnings. That doesn't mean it's not still a stock that Wall Street likes. Clearly, we're getting a nice reaction here and another breakout. I would be careful, though, if we fail to hold the breakout, if we get a big reversal later today. All right, let's do the three you must see, and then we'll wrap up. So I'm going to start with CBLI. So CBLI, the reason I wanted to point this out, it's a small company, Cleveland Biolabs, but look at the candles. Do you see how we were trying to break out above this double top and we failed? The last thing you would do, if you owned a stock and it was up at $7.10 or whatever it was, and it closed at 640 or 630, you'd probably be like, I don't want to sell now. I could have sold at 710. I don't want to sell at 630. But look what happened over the next several days. We were down to 430. It went down another 30% from where it was after it failed the breakout. Anytime I see these false breakouts, it makes me nervous. And here we had a multi-month double top at $7. We had it intraday and failed, and then we came back down. But the interesting part here is that now we're back down to where we've seen support, and we put in a hammer yesterday. So yesterday's low, I think, is a pretty important low, and that's down somewhere around the 430 area. Now, this is a very volatile stock, small cap biotech. So you wouldn't even want to be in this unless you're a very, very aggressive trader. But I do find this chart interesting, and that's the reason I wanted to include it for this analysis, is just the way the candles have shaped. The reversing candle, the move lower. Now we've got a reversing candle. Will we in turn move back to the upside? We'll find out. MIME. This is Mimecast. It is a software stock, and it has been performing well, and it has been moving up above its 20-day. However, back on Monday, you can see that was a very ugly reversing candle, in my opinion. And I'm going to check. another chart on MIME because I just want to see if there's a negative divergence, and there is. So you've got higher prices, lower PPO, reversing candle. I would be careful on MIME. Doesn't mean we won't go up above 58, 59, 60 and breakout. Anything is possible. What we're talking about is odds. Negative divergence, reversing candle. I generally use that as a sign to sell. So I would be out of MIME. TDY. I like what happened yesterday. Look at the volume pickup. And after moving off of this low, putting in sideways consolidation, we broke out again. We're generally in a longer term uptrend. I would look for TDY, Teledyne Technologies, to make a run back toward this previous high. The other thing is coming off of this low with all the selling on this pullback, we're now starting to see the AD line rise again, which is nice. And then if we take a look at the relative chart on TDY, it's in the aerospace area. It put in effectively a double bottom, and now it's starting to turn back to the upside. If we can get a break above 0.29 on the relative chart, that will then tell us that we may have a leader here in the aerospace group. So things definitely improving here with TDY. All right, that's it for me. Let's see what the market's doing here. See if we're holding on to our gains. So for now, we got the Dow up 123. The S&P is up 22. NASDAQ's up 95. Up 2/3%. So on a relative basis, doing pretty well. Small caps, mid caps performing a little bit better today as well. So that's good. VIX down below 16, down near the lows again. We'll see whether or not that matters. And yeah, so we'll see whether or not large caps continue to drive this market, whether others participate. But we are now starting earnings season. Once we get through this week, I think it's time to be much more cautious. And even with, watch the 10-year treasury yield, watch the growth versus value ratio, IWF:IWD on stock charts. That's how you get it. Again, that's IWF, all you do, IWF:IWD. Follow this ratio. I like to follow it using line chart. It's just easier to follow. It was going down for a while, double bottom. Now it's going up. So you can see the one thing I'll say, though, is that the growth portion of this is driven by those large cap growth names, the Apples and the Microsofts. The value, on the other hand, is much more diversified and is spread out among a lot of stocks. So the fact that Microsoft and Apple are doing well and some other big cap technology names, that's why we're seeing this ratio move back to the upside. I'm actually looking for other growth to value ratios that maybe provide us something that's a little more balanced. And I'll keep you posted on that. But anyway, that's it for today. I appreciate everybody tuning in. Sorry, I ran a little bit late. Have a great rest of your week. Won't be doing another one of these live shows until next Monday right here at earningsbeats.com. I do have a recorded show that will be airing over at Stock Charts TV at 9 a.m. Eastern. So just the stock charts, 9 a.m. tomorrow. Click on Stock Charts TV. And when you do, you should see under now playing Trading Places Live. All right, everybody have a great day. Hopefully see you over at Stock Charts TV tomorrow morning. Take care, everybody. Happy trading.